Have you ever wondered if all that frantic buying and selling in the stock market actually pays off? Well, welcome to Dollar Playbook. I'm Taylor Reed. Today, we've got a really fascinating explainer for you. We're skipping right past all the opinions and the internet hype to break down the real math of investing. We're going to look at the cold, hard numbers over a lifetime of building wealth to see who actually comes out on top. So let's just dive right into this. I want you to picture something for a second. We all have that one friend in our lives, maybe they're in your group text, who is just constantly bragging about their latest stock trades, right? They're always sharing screenshots of their green weeks, talking about catching the perfect momentum swing. And they seem absolutely convinced that anyone just sitting on a simple, boring portfolio is leaving serious money on the table. It looks like they're winning. Honestly, it feels like they're winning. But are they actually winning in the long run? That is exactly the question we're answering today. To see how this really plays out, let's look at a little parable of three 30-year-olds. We've got Tyler, Greg, and Ryan. Now, to keep the math completely fair here, they all earn the exact same salary of $75,000 a year. They live in the same city, and they have the exact same goal of retiring comfortably at 60. Most importantly, they each invest exactly $1,000 a month for 30 solid years. So, same money in, right? But their paths couldn't be more different. Tyler, he's our day trader. He's up before the opening bell, analyzing candlesticks charts, and making hundreds of trades a year. Then you've got Greg. He takes a middle path as a swing trader, holding his positions for maybe a few days or weeks. And then there's Ryan. Ryan does absolutely nothing. He buys one low-cost index fund every single month, and he just closes the app. Now, for the first few years, Tyler's hot streaks make him look like a total genius. But what Tyler doesn't realize is that his money is quietly draining away through invisible wealth leaks. So, here is the first major leak Tyler faces. I call it the short-term tax wrecking ball. You see, when you hold an investment for more than a year, your profits are taxed as long-term capital gains, which are actually incredibly favorable. But when you buy and sell inside a single year, which is literally every single trade Tyler makes, that profit is considered a short-term gain, and that means it gets taxed as ordinary income at your full paycheck rate. For our guys earning $75,000, that puts them in the 22% bracket at the federal level. So every single winning trade Tyler makes hands roughly a fifth of his gains straight over to the IRS right then and there. It completely destroys the ability of that money to compound over the next 3 decades. And then, we've got the part those group chat screenshots never, ever show, the statistical reality. The data we have on this is some of the most thorough in all of finance. A landmark study actually showed that fewer than 1% of day traders earn reliable profits. Fewer than 1%? Research down in Brazil found that 97% lost money over the course of a year. And a really famous study of United States investors showed that active traders underperform the broader market by about 6.5 percentage points every single year. But look, for the sake of this explainer, we're going to be incredibly generous. Let's just assume Tyler is in that ultra-rare percentage that actually turns a consistent profit. Even with that wildly optimistic assumption, the math is still working against him. Because that brings us to the second invisible leak. It's a quiet little 2%. We call this trading friction. See, every single time Tyler makes a trade, he pays a tiny, almost unnoticeable cost in the spread between the buy and sell price. Throw in occasional fees and a little slippage, and on just one trade, it's maybe just a few cents. No big deal, right? But Tyler is turning his entire account over 20 times a year. This constant friction quietly evaporates roughly 2% of his money every single year, and that happens before he's even made a single dollar of actual profit. So the really crucial point here is understanding these unseen forces that are just constantly working against active traders. You've got ordinary income taxes absolutely gutting your compounding. You've got constant trading friction slowly draining your balance. And then there's human overconfidence, that really well-documented trap of selling your winners way too early and holding onto your losers for way too long. Now you might be thinking, well, what about Greg? Our swing trader trades way less often, so he's got this figured out. And it's true, Greg bleeds less than Tyler because his friction costs are lower. But he still bleeds. He's still holding almost everything for less than a year. So he's still getting slammed at that 22% tax bracket on all his wins. And he's still trying to perfectly time an unpredictable market.
And this right here is exactly why Ryan's strategy is so powerful. It works precisely because it is so incredibly boring. Ryan just buys one low-cost S&P 500 index fund for $1,000 every single month. Then he closes the app. He almost never sells, which means he almost never triggers a taxable event. His money is allowed to compound entirely untouched for 30 years, totally dodging the tax wrecking ball and avoiding all that friction. He's literally just letting hundreds of the largest companies in America do all the heavy lifting for him.
Now, watching how this wealth builds on a timeline over 30 years reveals a pretty brutal truth. In year 5, they all look pretty close. Tyler's sitting at about $63,000 and Ryan's at $75,000. But watch how this gap violently rips open. By year 10, Tyler is almost $60,000 behind Ryan. By year 20, Ryan has over $656,000. That is more than double what Tyler has built. And by year 25, it's just rough to look at. Ryan is sitting on nearly $2 million. The man who literally never opened the app has nearly $700,000 more than the man who is stressing over the market every single day. So, here is the final scoreboard after 30 years of investing $1,000 a month. Tyler, our highly active day trader, finishes with roughly $511,000. Greg, the middle ground swing trader, lands at $812,000. And Ryan finishes with an incredible $1,778,000. Ryan ends up with more than 3 times what Tyler built. He beat him by nearly $1 million. And remember, we gave Tyler the optimistic math where he was actually a profitable trader. The taxes and the friction still absolutely buried him.
But wait, there is one last cost in Tyler's story, and honestly, I think it's the most devastating one of all. 60,000 hours. We just measured the dollars, sure, but we also have to measure the time, because that's the one currency you can never, ever earn back. Think about it. Watching the market all day, prepping in the early morning, reviewing trades late at night. Tyler spent roughly 2,000 hours a year on his trading. Over 30 years, that is 60,000 hours. That is the exact equivalent of working a second full-time career for 3 solid decades.
Just look at this contrast for a second. Tyler spent 60,000 hours of his one precious life to finish in last place. Ryan, on the other hand, spent maybe 4 hours a year, literally just a few minutes each month, to make his automated purchase and occasionally glance at his balance. Over 30 years, Ryan spent 120 hours total. That is just 3 working weeks of his entire life. The man who worked a grinding second career finished last, and the man who spent 3 weeks finished first, with over $1 million more in the bank. In investing, activity simply does not equal progress.
So what is the practical, everyday lesson we can take from all this? Well, here's your wealth-building playbook. Step 1. Build your core wealth in low-cost index funds. Put the vast majority, like 95% of your money, in this boring engine where you benefit from lower taxes, rock-bottom costs, and historical compounding. Step 2. If you really have the urge to trade, wall it off. Take 5% and treat it as your casino fund. Ideally, do it in a tax-sheltered account like a Roth IRA so the taxes don't bleed you dry. Just never let the fun money touch your future money. And step 3. Check the real scoreboard. Always measure your returns against a simple index. And always count your time as a real cost.
I'm going to leave you with this final thought for today. The market doesn't pay you for effort, it pays you for patience. So ask yourself right now, are you investing to create a stressful second job for yourself, or are you investing to eventually buy back your freedom? You work hard for your money and you absolutely deserve a stable, comfortable life without sacrificing all your free time to a glowing trading screen. Well, thank everyone for joining me on this explainer. If you found this breakdown helpful in understanding how to better manage your money and your time, please gently tap that like button, share this with a friend who really needs to see the real math, and subscribe to Dollar Playbook for more practical financial lessons. I'm Taylor Reed. See you next time.